People ask me all the time, Warren, what's the secret? How do you know which stocks will make money? They imagine there's some hidden formula locked away in Omaha, something only billionaires have access to. They think successful investing requires complicated spreadsheets, advanced mathematics, and teams of analysts staring at computer screens all day. The truth is much simpler than that. After more than 70 years of studying businesses, buying stocks, making mistakes, and building wealth, I've learned that most people are looking in the wrong places. They focus on stock prices, market predictions, and breaking news. Meanwhile, the most important information is sitting quietly inside the business itself. Let me tell you something that may surprise you. Before I invest in any company, I focus on just 3 numbers. That's it. Not 30, not 300, just 3. And those 3 numbers have helped me identify some of the greatest investments of my life. The reason most investors struggle isn't because investing is difficult. It's because they make it complicated. Wall Street benefits when you believe investing is mysterious. They want you glued to market updates and economic forecasts, but wealth isn't built through constant activity. Wealth is built through understanding. If you can identify a wonderful business, buy it at a sensible price, and hold it patiently, you can outperform most investors without ever needing to predict what the market will do. Next, back in the late 1980s, I began buying shares of a company that almost everyone on earth already knew. There was nothing flashy about it. It wasn't the newest technology. It wasn't disrupting an industry. It wasn't appearing on magazine covers every week. In fact, many people thought I was making a mistake. They argued the stock had already gone up too much. Others believed newer companies would eventually replace it. But while everyone else focused on opinions, I focused on facts. I looked at a few simple numbers and saw something extraordinary. I saw a business with loyal customers, powerful economics, and a competitive advantage that would likely last for decades. That company was Coca-Cola. Today, that investment has generated enormous returns, but at the time it looked boring. That's one of the most important lessons in investing. Great opportunities rarely look exciting. Most people chase excitement because excitement feels productive. They want action. They want movement. They want the thrill of finding the next big thing. But investing isn't entertainment. Investing is ownership. When you buy a stock, you're buying a piece of a real business. The question isn't whether the stock price goes up tomorrow. The question is whether the business will continue creating value 10, 20, or 30 years from now. Once you begin thinking like an owner instead of a trader, everything changes. One of the biggest misconceptions about investing is that intelligence is the deciding factor. It isn't. Over the years, I've met incredibly intelligent people who lost fortunes because they lacked discipline. I've also met ordinary people who built significant wealth simply because they followed simple principles consistently. Investing is not an IQ competition. It is a behavior competition. The market rewards patience far more than brilliance. Most investors know what they should do, but very few actually do it. They buy when prices are high because everyone else is buying. They panic when prices fall because everyone else is panicking. They allow emotions to control decisions that should be controlled by logic. This is why temperament matters more than intelligence. If you can remain calm while others become emotional, you already possess a tremendous advantage. Successful investing is often about avoiding mistakes rather than finding genius opportunities. Every major financial disaster usually begins with emotion taking control. Fear causes people to sell great businesses at terrible prices. Greed causes people to overpay for mediocre businesses. Patience, on the other hand, allows compounding to work, and compounding is where true wealth is created. The longer you stay invested in exceptional businesses, the more powerful the results become. The first number I always pay attention to tells me whether a business is actually good at turning resources into profits. Most people never look at this. They're too busy watching stock prices move up and down. But stock prices don't tell you how strong a business really is. A business can have a rising stock price and still be weak. Underneath, what I want to know is whether management is creating value consistently year after year. Imagine 2 businesses. Both have the same amount of money invested in them. One company produces enormous profits from those resources. The other struggles to generate meaningful returns. Which business would you rather own? The answer seems obvious, yet many investors never ask this question. Great businesses have a way of producing strong returns repeatedly over long periods. That's usually a sign of a competitive advantage. Maybe customers love the brand. Maybe competitors can't easily replicate the product. Maybe the company has a unique position in its industry. Whatever the reason, consistently strong profitability is often evidence of something special. That's why I spend far more time studying the business than studying the stock chart. Charts tell you what happened yesterday. Business quality helps predict what could happen over decades. One of my favorite investments taught me this lesson perfectly. Years ago, Berkshire acquired a small candy company. On the surface, it didn't look particularly impressive. It wasn't a technology giant. It wasn't changing the world. It simply sold chocolates. Many people couldn't understand why I was interested, but when I looked deeper, I saw something powerful. Customers loved the product. The company generated exceptional profits, and year after year it turned invested capital into even more money. That's exactly what you want to see. Great businesses don't constantly need huge amounts of new investment just to survive. They generate cash. They create value. They reward ownership. Over time, that small candy company produced returns far beyond what most people imagined possible. The lesson wasn't about candy. The lesson was about economics. Wonderful businesses often look ordinary from the outside. That's why investors who focus only on headlines miss so many opportunities. The market loves excitement, but wealth usually comes from consistency. A business that quietly produces strong returns for decades is often far more valuable than a flashy company everyone is talking about today. That's why whenever I analyze an investment, I start by asking a simple question. Does this business consistently turn resources into profits better than its competitors? If the answer is yes, I keep looking. If the answer is no, I usually move on. The second number I always study tells me something incredibly important. It tells me whether a business can survive when things go wrong. Most investors spend all their time thinking about profits, but very few spend enough time thinking about risk. And risk matters because every business eventually faces difficult times. Markets decline. Customers spend less. Competition increases. Unexpected problems appear. The question isn't whether challenges will come. The question is whether the business can survive them. This is where debt becomes so important. Debt can make a good business look great during good times. Borrowed money allows companies to expand faster, grow quicker, and report stronger results. But debt is like fire. Used carefully, it can be helpful. Used recklessly, it can destroy everything. I've seen countless businesses collapse not because they lacked customers, but because they carried too much debt. When sales slowed, the debt remained. When profits fell, the debt remained. The bank didn't care that conditions became difficult. The payments still had to be made. That's why I prefer businesses that don't depend heavily on borrowed money. Strong companies should be able to stand on their own feet. They should be able to weather storms without constantly worrying about creditors. Financial strength isn't exciting, but it creates something every investor should value deeply. It creates peace of mind, and peace of mind allows you to hold great businesses through difficult periods while everyone else panics. One of the most expensive mistakes I ever made taught me this lesson the hard way. Many years ago, I bought a textile company because it looked cheap. The numbers suggested I was getting a bargain. The stock traded at a low price. The assets seemed valuable. Everything looked attractive on paper. But I overlooked something much more important. The business itself was weak. The industry was struggling. Competition was increasing. And despite all my efforts, the economics simply weren't favorable. I spent years trying to fix a problem that couldn't really be fixed. Looking back, I learned one of the most valuable lessons of my entire career. A mediocre business at a cheap price is often far more dangerous than a wonderful business at a fair price. Most investors become obsessed with finding bargains. They want the cheapest stock. They want the lowest price. But a cheap business can become even cheaper. Meanwhile, a truly exceptional business has the ability to create value year after year. That lesson changed the way I invest forever. Today, I'd much rather own a wonderful business at a reasonable price than a mediocre business at a bargain price. Quality matters. In fact, quality matters so much that it can compensate for many other imperfections. But weakness rarely compensates for anything. When I study a business, I always imagine what might happen during difficult economic conditions. Most investors focus on best-case scenarios. They imagine rapid growth, rising stock prices, and expanding profits. I prefer thinking differently. I ask myself what happens if things don't go according to plan. What happens if sales decline? What happens if customers spend less? What happens if the economy enters a recession? Strong businesses can survive these situations. Weak businesses often cannot. That's why I pay so much attention to financial strength. Think about it this way. Imagine two ships crossing the ocean. One is built with extraordinary strength and stability. The other is designed only for perfect weather. Which ship would you rather be on when the storm arrives? Investing works exactly the same way. Nobody knows when the next recession will occur. Nobody knows when markets will decline, but eventually they will. And when they do, financially strong businesses usually emerge even stronger because weaker competitors disappear. Great companies don't just survive difficult times. They often use those moments to gain market share, strengthen their position, and create opportunities. That's why financial strength isn't just about protection. It's also about future opportunity. One company that impressed me greatly in this regard was Apple. When many people think about Apple, they think about technology. They think about innovation, smartphones, and new products. I looked at it differently. I saw a business with one of the strongest brands in the world. I saw customers who loved the product. And perhaps most importantly, I saw a company generating enormous amounts of cash. Cash creates flexibility. Cash creates strength. Cash allows a business to invest, innovate, and survive challenges without depending heavily on outside financing. That's one reason I became comfortable investing billions of dollars into Apple. I wasn't trying to predict what technology would look like 20 years later. I was looking at the economics of the business. Great investing is often simpler than people think. You don't need to predict the future perfectly. You simply need to identify businesses with strong competitive advantages, sound finances, and capable management. Then you allow time to do the heavy lifting. The world changes constantly. But certain business principles remain remarkably consistent. Strong companies tend to become stronger. Weak companies tend to become weaker. Understanding that simple truth can dramatically improve your investment results. The third number I focus on may be the most misunderstood of all. It answers a question every investor should ask before buying anything. How much am I paying for what I'm getting? This sounds obvious, but most people ignore it completely. They become excited about a company and stop thinking about price, but price matters. In fact, price determines much of your future return. Imagine finding the most beautiful house in your city. It's in a perfect neighborhood. The design is stunning. The location is ideal. But what if someone asks 10 times its actual value? Suddenly it becomes a terrible investment. The same principle applies to stocks. Even wonderful businesses can become poor investments if purchased at unreasonable prices. That's why I always remember a lesson taught to me many decades ago. Price is what you pay. Value is what you get. Those words sound simple, but they contain enormous wisdom. The market constantly offers opportunities to buy businesses. Sometimes prices become too high because investors become overly optimistic. Other times prices become too low because investors become fearful. My job isn't to predict short-term market movements. My job is to identify situations where value exceeds price. When I find a wonderful business, a strong balance sheet, and a reasonable valuation all at the same time, that's when I become interested, because that's where long-term wealth is often created. One mistake I see investors make over and over again is falling in love with stories instead of businesses. Wall Street is full of exciting stories. Every year there's a new trend, a new industry, a new technology that promises to change the world. Investors rush in because they fear missing out. They hear predictions of explosive growth and imagine easy profits. But investing is not about finding the most exciting story. It's about finding businesses that can consistently generate profits over long periods of time. Growth is wonderful, but only when it's profitable growth. A company can double its sales every year and still destroy shareholder value if it's spending more money than it earns. That's why I always focus on the economics underneath the story. Great businesses don't need constant excitement. They quietly create value year after year. Their customers return, their profits grow, their competitive advantages remain strong. Those are the businesses I want to own. The stock market often rewards excitement in the short term, but over decades it rewards fundamentals. Investors who chase stories usually experience emotional highs and lows. Investors who focus on business quality tend to sleep much better at night. And in my experience, sleeping well while your investments compound is one of the greatest advantages an investor can have. Many people ask me whether I regret missing certain opportunities. The honest answer is yes. Throughout my career, there were incredible businesses I failed to buy. Some became enormously successful. Some transformed entire industries. Looking back, it's easy to point at those opportunities and wish I had acted differently. But investing isn't about perfection. It's about discipline. Every investor will miss opportunities. Every investor will make mistakes. The goal is not to catch every winner. The goal is to avoid catastrophic losses while consistently making good decisions. That's a much more achievable objective. One reason I've survived in the investment world for so long is because I accepted early that I don't need every opportunity. There are thousands of companies available. I only need a few exceptional ones. Most people lose money because they feel pressure to constantly do something. They think activity equals progress. But sometimes the best decision is doing nothing. Patience can be a competitive advantage. In investing, you don't get paid for being busy. You get paid for being right, and often being right requires waiting far longer than most people are comfortable with. This brings me to one of my favorite concepts, the circle of competence. Every investor has areas they understand and areas they don't. The key is knowing the difference. One of the most dangerous things in finance is pretending to understand something you actually don't. People become excited by trends, hear success stories, and suddenly convince themselves they're experts. That usually ends badly. I have spent my entire career staying within areas I understand reasonably well. Does that mean I missed opportunities? Absolutely. But it also protected me from many disasters. You don't need to understand every industry. You don't need to invest in every opportunity. You simply need enough opportunities within your circle of competence. Imagine a baseball player. They don't swing at every pitch. They wait for pitches they can hit well. Investing works exactly the same way. Everyday opportunities pass by. Some are attractive, some are dangerous. The challenge isn't finding something to buy. The challenge is waiting for opportunities that match your knowledge, your understanding, and your criteria. That's how long-term wealth is built, not through constant action, but through selective action. One of the greatest advantages individual investors have is the ability to be patient. Professional money managers often face enormous pressure. They must explain every decision. They must report results constantly. They are expected to always be doing something. Individual investors don't have those constraints. They can wait. They can study. They can think. They can allow opportunities to come to them. That's incredibly powerful. Imagine standing at a baseball plate where nobody forces you to swing. One pitch goes by, then another, then another. You can wait as long as necessary until you see exactly what you're looking for. That's investing. Most people become impatient. They feel uncomfortable holding cash. They feel pressure to act. But patience is often where the greatest opportunities come from. Markets eventually become emotional. Fear eventually creates bargains. Greed eventually creates excesses. The patient investor can take advantage of both situations. The impatient investor usually becomes part of the crowd, and following crowds rarely leads to extraordinary results. Wealth is often built by doing simple things consistently while resisting the temptation to do foolish things impulsively. So let me leave you with the most important lesson from everything we've discussed. Successful investing is not about finding secret formulas. It's not about predicting the next market crash. It's not about trading constantly or chasing headlines. It's about understanding businesses. It's about buying quality. It's about protecting yourself from unnecessary risk. And it's about paying reasonable prices for wonderful companies. The three numbers we've discussed are powerful because they simplify the process. They help you focus on what actually matters. They help you ignore noise. They help you think like an owner instead of a speculator. Most people spend their lives searching for shortcuts, but wealth is rarely built through shortcuts. It's built through patience, discipline, and consistency. Great businesses create value. Strong balance sheets provide safety. Sensible prices create opportunity. Put those ingredients together and time can do remarkable things. The market will continue changing. New technologies will emerge. New trends will capture attention. But the principles of investing remain surprisingly constant. Find wonderful businesses. Buy them intelligently. Hold them patiently. Let compounding work. That's how fortunes are built. Not overnight, not through luck, but through simple decisions repeated consistently over very long periods of time. And if there's one thing I've learned after decades in the market, it's that simple done consistently almost always beats complicated done emotionally.